so today I want to talk about what most investors are getting wrong right now. They're focusing on headlines, but the real signals are hidden in plain sight. Today I'm breaking down 3 things the markets are getting wrong currently, what the data is actually saying, and how I'm personally positioning my own portfolio. Let's dive right into it. All right, what's up everyone? This is Stock Brock, where I like to talk about the markets, break down stocks, earnings without all the noise. If you like data-driven investing, make sure you like, subscribe. Thanks for watching. Let's dive right in. All right, point number 1, the market is misreading interest rates. The first thing the market is getting wrong is interest rates. Everyone is debating when rate cuts will happen, but that's the wrong question to ask. What does higher for longer actually mean? And what does it do to earnings quality? To explain it simply, companies with real cash flow survive. Companies with cheap money business models will struggle. And this is why you're seeing dispersion in the market. The market isn't moving together, it's separating strong balance sheets from weak ones. One actionable takeaway for this point is I'm overweight companies with pricing power, low debt, and recurring revenue, not speculative growth that needs refinancing, because interest rates are going to be higher for longer. The second thing the market is missing, management commentary is more important than headlines. To explain that simply, revenue beats doesn't equal quality. Look for margin trends, cost discipline, and capital allocation discipline. When management is talking about efficiency and focus, that's not fluff, that's survival mode. And for example, if a company beats earnings, but margins are failing and buybacks are slowing, that's not bullish long-term for the company. An actionable takeaway for this second point is I'm prioritizing companies that show operational leverage, not just top-line growth. Point number 3, the biggest risk isn't a crash. The third thing the market is getting wrong might surprise you. The biggest risk right now isn't a crash, it's dead money. To explain this simply, sideways markets punish passive holders. Stock selection matters more than ever currently. If you're holding businesses with no catalyst, no margin expansion, and no capital return, you're wasting time. An actionable takeaway for this third point, I'm trimming positions that don't have a clear 12 to 24 month thesis and reallocating into names with visible execution. And the final point, how I'm positioning my portfolio. So how I'm personally positioning, I'm structuring it clean. Core holdings, high quality compounders, opportunistic ads, earnings volatility setups, companies with cash, dry powder for mispricing. So I'm simply not chasing any hype. I'm letting volatility work for me. All right, thanks for watching, guys. If you want me to break down a specific stock or earnings report next, drop it in the comments below. Like this video if it helped. Thanks for watching. Stock Brock. Peace.